Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello friends, welcome to the demo session of alternative investments, and today we are going to be covering hedge funds on alternative investments. We are going to be covering relative value strategies. What do you mean by relative value strategies? What actually happens in that? What does somebody long? What does somebody short? Okay, all of that we're going to discuss. Now, as far as alternative investments is concerned, hedge funds is a very important topic as well as concept, right? A lot of students do aspire to get into roles in hedge funds. So if you're planning to take your CFA level 2 exams anytime soon, this is one topic that you should definitely not ignore. If you have any queries or doubts or anything that you have in this chapter, feel free to reach out to us and we are here to assist you. Okay, so now let's wait no further and let's get right into it onto the demo session of what I took in my actual class. So relative value means basically you are trying to exploit difference between two securities relative to one to other. So the most common securities used in this are hybrid convertible debt, though other type of fixed income also may be used. When successful relative strategies learn various premiums over time, including liquidity, credit, and volatility. Please note this word. These are the credits that they will earn. These are the, premiums that they will earn. When successful, write this in the first column itself. That is, what is that? First one, investment type, no? First column is investment type. In that it is right, will earn various premiums, including liquidity, credit, volatility. So, will earn liquidity, credit, and volatility premiums.
Will earn liquidity, credit,
and volatility premiums.
Volatility premiums. Okay.
But please go to volatility and write losses can occur during volatile times. Or you can say high volatility. No, not high volatility. I think you should say turbulent time losses, because I don't think volatility is very high in this. Let us see. You just say losses can occur in volatility. That's all. So we are looking at two kinds of relative strategies. One is fixed income arbitrage and the second one is converts. What is fixed income arbitrage? Mispricing of fixed income instruments by going long undervalued securities and going short comparatively overvalued securities. Other idiosyncrasies that might be exploited include yield curve kinks or anticipate change in shape of the yield curve. Now, what happens is you often strategy. We'll see about strategy later. You do this for variety of instruments. So let us say HDFC and Reliance, both of them are AAA. But Reliance bonds are trading at a yield to maturity of 10% and the HDFC bonds are trading at a yield to maturity of, let's say, 9%. Right. So if Reliance is trading at 9%, Reliance to trend upwards, yield is low, but the price is high. So Reliance bonds are trading at a very high price. So you will short Reliance bonds. HDFC bonds are trading at YTM of 10%. Right. So the yield will come down, so the price will rise. So you will long HDFC bonds. So you will do things like this within the same credit class. Or let's say HDFC bond, one bond is going, 1 year bond is at a different yield and a 2 year bond is at a very different yield. Whereas in market, 1 year and 2 year rates are very, very close. Right. So whatever is overvalued, you will sell. Whatever is undervalued, you will buy. Right. Within the same security. See, you are not exposed to credit risk if you buy HDFC and sell HDFC, no? Bond. Right. So you eliminate the credit risk, but you are playing on the yield spread. Market may the spread between Reliance 1 year and Reliance 2 year, let's say, is 50 basis points. But the HDFC, the spread is 500 basis points. Then you will say about something is wrong with HDFC. You will go and long something which is undervalued, short something which is overvalued. So you do things like this. Then what are the two types? In this, there are two types. One is called yield curve, which is what I was discussing, and carry trades. Yield curve, the hedge fund manager will form a view of how the shape of the yield curve will evolve over time. The portfolio manager then makes long and short in fixed income instruments. They will profit when the price of long rises and short falls. If the positions are taken in securities of different firms, then you will also have liquidity, credit, and interest rate risks. For positions of same issuer, only interest rate movements will be the main source of risk. So you will go long on some, go short on the other. If it is across different companies, then credit risk also will be there. But if it is in the same company, only the interest rate will be the risk. And especially if it is different firms, no, you also have this other problem. which is one company may be liquid, other company may not be liquid, securities. Whereas if it is same company, even if they are illiquid, it doesn't matter. You can, both are securities of the same firm. You can hold them. Right. So whereas in case of two different companies, there is an issue. Then carry trade. Do you remember cash and carry arbitrage? Covered interest arbitrage, carry trade. We use these words in forex as well as in derivatives and other places. So when interest rates are not reflecting the true prices, or the prices are not reflecting the true interest rates, then we'll go and play around with it. What you will do is, portfolio shorts a low yielding security and goes long on a high yielding security. The source of return is yield differential and price change as reversion occurs. So if the yield is very, very high, what will happen? The price is very, very low. So as the price starts moving up, then yield will come to its normal range. So please write in this one, what is this? Fixed income arbitrage. Please write carry trade as well as yield curve trades in the investment thing. What is that? Investment. What is the first column? Investment
characteristics.
Please write in that yield curve. No, it is not investment. I think it is strategy implementation. In strategy implementation, please write carry trade and yield curve trades. Okay. Now come see this. Because fixed income securities tend to be priced efficiently. So fixed income market is very efficient. Why do you think so? Because you're handling fewer risks. You're handling only interest rate risk and credit risk and liquidity risk. Whereas when it comes, so what are the factors that determine the price of a bond? Market interest rate is the only factor, and default risk of the company, correct? These are the only two factors which determine the price of a bond. Yes or no?
Yeah.
Whereas it comes to equity, rest of the market, government policy, regulation, company bankruptcy, market interest rates, growth of the industry, technology, competitor, you have hazard things that determine. That doesn't happen in fixed income. So fixed income markets are more easy to price. Which is why historically, if you look world over, fixed income markets are very, very large than your stock markets. Because government, first of all, government bonds are there. Then even non-government private sector corporate bonds also there in large numbers. Because the pricing is more efficient. Right? So please see this. 400 to 15%, 1500% leverage. Please write down in the leverage column 400 to 1500%.
So where are we? We are still in fixed income only, no?
Fixed income only, fixed income. We have not gone beyond fixed income.
400% leverage.
See, there are relative, I said there are two things. One is fixed income, second is converts. We are still in fixed income.
400% leverage.
400 to 1500% leverage. Okay, so please note one more thing. Did we have a column on liquidity? We didn't have, or I asked you to add. I didn't ask.
You asked to add.
So in that, please write down liquidity depends on strategy employed. So if you have government bonds or US treasuries, it is very liquid. But you used MBS or foreign instruments or illiquid companies and all that, then it is liquidity will be low. So liquidity depends on kinds of instrument.
Okay.
Then the returns. The returns tend to be very similar to writing puts. So if you keep on writing puts, whatever are the returns, it will be very similar to writing puts. Please write this down, roll in portfolio, or you can write in return also. Returns similar to writing puts. Okay, but please note, if things happen normally, you will make return. If things go even slightly wrong, because you have 15%, 15x leverage, most of the money will go away in leverage. The leverage. So you know how this works, right? When you say leverage, I borrow 10 from you, I have my own 10, I borrow 100 from you, I have 10 rupees of my own, we invest that 110 in somewhere. On this 110, let us say I get 5% return. So 110 into 5% is
1.1.
5.05, I think.
Yeah.
5.05. The interest that I pay you, let us say, is 5. Then I make 0.05. But let's say interest I am supposed to pay you is only 1%. Then 4% is the return that I get. By investing 10 rupees, I've got 4 rupees back. Whereas by investing 100 rupees, you've got 1 rupee back. So it depends a lot on interest rate. If the return is low, entire company goes bankrupt. or the entire transaction goes wrong and the hedge fund, will really suffer. That is why a lot of hedge funds keep shutting down in US. It is very, very normal. Just like, they open Pani Puri Bandi in India, keep opening and shutting down hedge funds in US. Okay. One drawback to fixed income strategies is highly leveraged structure can cause modest volatility to lead to a domino effect of margin calls and deleveraging. Asian financial crisis, ruble crisis, and long-term capital management. Have you heard of long-term capital management?
No, this is a company name.
Yeah, so there was a company called Long-Term Capital Management, which is founded by Nobel Prize winner. I forget his name. Okay. They earned a lot of money over 3-4 years in early mid-90s. Suddenly, something didn't go as planned. Because he was Nobel Prize winner, a lot of people gave him money. Full leverage, 10x leverage, 15x leverage. One day something went wrong, whole company collapsed. And not only that, because of that collapse, it led to a systemic collapse. Because when suddenly somebody goes bust, hey, did you see the movie Big Shot?
Yeah, I saw.
You saw, no? So if something happens to one entity, very large player in the financial ecosystem, it has a domino effect on others because they will start disposing of securities. If everybody is trading on leverage, so if the market prices go down, if you pledged any shares or pledged anything, people will invoke the margin call and they will sell. So Fed had to come in and stop trading and say that, we will honor everything, we will take care of everything. And then the crisis, stabilized. Just like what happened in 2008, in late 90s also, this long-term capital management also did like that only. Right. So this is the other issue. Please write in beside, I think what is this? This is role in portfolio. You can write this thing that modest volatility has domino effect. Role in portfolio, modest volatility has domino effect. Okay.
Modest volatility has a role in domino effect. Okay.
Then you have convertible bond arbitrage, typically called converts. Okay, that's a market slang for convertible bonds, converts. They are fixed income securities with regular payments, but can be exchanged for shares and all that. We know what all it is. Okay. Now, the problem with the convertible bonds is very difficult to analyze how it functions. Okay. The goal of these strategies is to profit from purchasing implied volatility of the bonds, which is often underpriced. Okay. So I'll explain what this means. To accomplish this without taking on excess potential loss, convertible bond arbitrage will take other position in order to hedge the delta and gamma risk of the convertible bond. So when you're going long on volatility. Okay, when you're buying any security, you're basically going long on volatility. Right? Now, when you're in a convertible bond, what is a convertible bond? It's a bond plus an option to buy a share. Correct?
Yeah.
Options have volatility. Correct? No, Black-Scholes.
Yeah.
So when you're buying a convertible bond, you're going long on an option. Basically, you're going long on volatility.
When I'm buying an option, I'm going long.
Convert. When you're buying a convert.
Convert.
You're buying a convert, you're also buying a bond, an option along with it.
Yes.
So when you're buying an option, you're buying volatility.
Yes.
Now, what is implied volatility?
What is implied volatility?
If you remember, I told you implied volatility is in market, the option prices trade. We compute based on what we think is the volatility, but market there is an option price. You input all other parameters into Black-Scholes and find out the balancing number as volatility. Such a volatility is called market implied volatility.
Okay.
Okay. So in convertible bond strategies, you purchasing the implied volatility of the convertible bonds. So basically, whatever is the price of the convertible bond reflects also see, if a normal bond is a convertible bond, what is the difference? Normal bond plus price of the option is the price of a convert.
So come again.
Price of a normal bond plus price of an option is equal to price of a convert.
Yes.
Right. So when you're buying a convert, you are also buying the implied volatility on the option to buy the stock.
Yeah.
Correct. That's all they're saying.
Hmm.
Okay. Now, to accomplish this without taking on excess risk, they will do delta hedging. You remember we were discussing delta hedging and gamma, delta and gamma. Delta is change in the price of the option due to change in share price. Gamma is rate of change of delta.
Ah,
You forgot, only 1 week ago we studied this.
yeah, no, it was there in that Greeks.
Correct,
Option
correct.
Greeks.
So when you do a convertible bond, because there is an option inside it, you will also do delta and gamma hedging to eliminate excess risk or excess potential losses.
Hmm. Hmm.
Okay. So please write this fact in convertible bond arbitrage mein, investment characteristics mein, you write, buying implied vols,
So where to write this?
write in investment characteristics only, in converts.
Okay.
Buy implied vols
I implied was
and hedge delta and gamma risk.
and gamma risk.
Ah.
So what is the meaning of this?
Huh? You do hedge. I just now explained, no?
It didn't register.
Correct. So a bond has convert is what? Plain bond plus option.
Yeah.
Option has volatility.
Mm-hmm.
When you are buying an option, you are buying volatility.
Yeah.
So first line is buying volatility.
Yeah.
That's what I said. Second line I said, whenever you have an option strategy, you hedge, you eliminate the risk by doing delta and gamma hedging, or you manage risk by doing delta and gamma risk management.
Mm-hmm.
So that's all I'm saying in this also. When you are trading in converts, you also have to enter into delta and gamma risk management strategies so that any risk can be eliminated. So just by buying a convert, you have not taken a position. Hedge fund will not only buy a convert, they will also actively do delta and gamma risk management. That is the meaning.
Okay. Okay. Got it. Got it.
Okay. Then investment characteristics, they have two kinds of liquidity issues, which is first one is strategy requires managed to short sell the underlying equity, and the second because fixed income instruments are investor often complex niche products. So what they mean is when you enter into a convertible arbitrage, you buy the bond, you sell the equity. The bond has bond plus option and you are selling equity.
Okay.
That is one strategy.
I am buying a convert.
And selling the same company ka equity.
Acha. I'm shorting that equity and I'm
Correct.
going long on the bond.
Correct. This is one strategy.
Okay.
Second strategy is the converts are difficult to price because you have an option, you have a bond, the bonds have multiple other risks associated with them. Convert has equity related risk associated with them. So there are multiple things. So when you do a convertible bond arbitrage, liquidity is a big concern. So please write in liquidity. Liquidity is a concern because pricing converts is tough and you're also shorting an equity.
Because pricing converts is tough and I'm shorting liquidity. What is difficult?
Shorting equity. See,
What
what has to happen? You have to buy a long and shorter equity. So liquidity may the problem will be if there is something wrong with the company, the equity that you have shorted, you'll make money. But then what you've gone long on the convert, you're not able to sell, dispose it off in the market. So you'll face issues where you're not able to manage both properly.
So, but the point of buying the equity was to hedge that only, na?
Hedge what?
The bond.
Hedge the convertible portion of the bond. Correct. But it is very difficult to unwind the position. That's all they're saying. You see, when the point was to hedge, agreed. But then option also has a maturity, no? What happens if the option is very close to maturity or in a convertible bond, the holder of the convert has a right to exercise at specific points of time, correct?
Yes.
So let us say we are very close to the exercise date.
Yes.
We are trying to hedge parallelly by selling equities.
Huh.
Suddenly something happens in the market where you're not able to exercise.
Yeah.
So very difficult to unwind a position from this kind of positions. So convertible
Acha.
is not an easy trade because you're doing multiple things. No, it may hedge you. Say the hedge is valid only if you are able to liquidate the hedge, boss. Okay, so there is one very statement. Okay, there is value in a stock only if you are able to sell the stock. Correct. No? You may think stock is worth so much. Only if you are able to liquidate it, there is value. So without liquidity, there is no value.
Yeah.
Right. Same logic applies here also. You enter into a strategy, but the strategy will be successful only when you're able to get out of the strategy and make money. If there is a liquidity problem, either disposing of one of them or to both of them, then there is no point of that strategy.
Yeah.
Okay. Your hedge may be greatly effective, but then you have to finally get out of that and make money, no? That's the point. Okay. Please write that part. Then convert strategies. They generally, convertible arbitrage strategy exploit low implied volatilities exhibited by options within convertible instruments compared to historical volatilities. The challenge is to hedge away the other source of risk that are embedded in security like market risk, interest rate risk, and credit risk of the bond issuer. So, low volatilities of converts. So, you see, when volatility is high, option price is very high, correct? Right. So let's say convertible bond is mispriced. It basically means that the volatility is not considered properly, and hence the value of the option is low, and hence the value of the convert is low. Okay. So same thing what we were discussing. If such kind of a situation happens, the challenge is to hedge other sources of risk, which are market risk, interest rate risk, and credit risk of the bond issuer. So when you're shorting equity or buying a convert and somehow hedging the convert, very difficult to hedge the interest rate risk, credit risk, and market risk. If you are trying to see, because here you are trying to play on the implied volatility, the option value has to go up. It is right now very less. It is trying to go up. If you want to be exposed only to the option value, which is the implied volatility or, which determines the option value, how will you eliminate all other factors? Even if you do, selling of equity or, selling of some other bond of the same company and all of that, even then it is a very, very difficult thing. If you do too many things, the trade becomes complex. And if you do too many things, because it is complex, liquidity also is a very difficult task. Okay. So in this, we've already written, you've written about the volatility already, right? Low volatility.
So the previous thing, what is the statement? I didn't write it down.
Sorry, you didn't write it down. So
low volatility.
I said something. Wait. Buy volatility and hedge delta and hedge using delta and gamma. And hedge the delta and gamma risk. I'm sorry. Buy volatility and hedge the delta and gamma risk.
That I got.
Okay,
that
after that, I didn't say anything.
After that, just now.
I didn't say anything.
Just now when I drank water.
No, I wasn't saying anything. I was just asking. Anyway, let us see. If there is something, so we talked about liquidity, no? I said liquidity is poor.
Actually,
liquidity is poor. So you can write somewhere liquidity is poor because of complex products.
Yeah.
Complex products, low liquidity. Okay. Then when a convertible bond's current price is well above the stock price, the out of the money call, that is delta is closer to zero, will lead to bond behaving like a straight bond because conversion of the stock is unlikely. Okay. Conversely, when a bond is well below the stock price, in the money call will cause the convertible bond behave like a corresponding stock because conversion is likely. So these two statements, did you understand these two statements? Please read. Tell me if you have understood those two statements.
Convertible bonds by the out of the money call will lead to convertible bond behaving much like a straight bond because the conversion of the stock is unlikely. Okay. Conversely, when a convertible bonds when the current stock price in the money call with delta near 1 will cause the convertible bond to behave much like the corresponding stock. Okay. Yeah.
Understood, no?
Yeah. So, Josh, can you tell me what delta is again?
What is delta?
Delta.
Delta is change in stock, change in the price of the call, or change in the price of an option due to change in the price of the stock. So, if let us say, think of the situation where I have I'll write it in, no, why should I do this? I'll write it here on screen. Let's say it's a buy call. Okay. Spot is 50. Call strike. I have a right to buy the share at 2,500. What do you think will be the value of this call? The time is 1 year.
0.
0 नहीं, कुछ तो रहेगा, time value रहेगा, volatility रहेगा.
It's very out of the money.
Insignificant, very insignificant, right?
Yeah.
Call price, let us take 1 rupee. Now, spot moves from 50 to 100. There is a 100% change. What do you think will be the price of the call?
Same.
Probably 1.
Almost the same. Yeah.
Probably 1.0. What is the change? 1%.
1%, yeah.
Correct? So, if the call is if the call is in the money, this is way out of the money, right?
Yeah.
Even if there is a significant change, there is no significant change in call price. So 1 by 100, that is change in call price by change in spot of the underlying security, is 1 by 100. This is delta. So delta is 1%. For a 100 rupees change, there is very, very small change. So if I have a call option, if I have 100 call options, I will hedge the movement in the call option price by selling a stock. Or if I have one stock, I will sell 100 call options in order to hedge both of them. So that ratio of what is the change in price of the call by change in price of the stock is delta. When you are exposed to, when you're doing a lot of options trading, or when you're doing a lot of let's say even stock trading for that matter, you try and hedge your portfolio by doing some delta hedging. When you're doing a lot of options trading, you will try and buy some shares here and there, just so that you're not really impacted significantly if there is a change in the price of the stock. So it is some way of hedging. Okay, so that is what is delta. Very, very simply put.
Change in price by change in
price of the option by change in price of the stock.
Yeah.
Here we are saying out of the money call, delta is close to 0, which is what we just saw.
Yes.
So let us say instead of spot being 50, spot is 2,419, or let's say 2,600. And price changes to 2,610. First of all, what is the call price if spot is 2,600 and strike price is 2,500?
What?
If spot is 2,600, call strike is 2,500, what is the price of the call?
100.
Minimum 100. 100 is intrinsic value. You'll have time value also. Let's take 150. Randomly, I'm putting a number. Okay. Then this 2,600 moves to 2,610. It increases by 10 rupees. Then how much will the call price move up to? Spot has moved by 10. So what will the call price move up to? Around 10.
10, yeah.
Around 10. Maybe 11, maybe 9, I don't know, but around 10. Right. So if the option is in the money, this is in the money, right? Because it is lower than spot. The option is in the money or at the money, the delta will be very, very close to 1, because this changed by 10 rupees. This also changed by 10 rupees.
Acha. Yeah, got.
Out of the money, then there is delta is very close to 0.
Yeah.
Okay. Then significant amounts of leverage are applied in implementing these bond strategies. 3 times bond exposure, 2 times short exposure of equity might be used. The smaller short equity hedges from delta hedging the short stock exposure according to delta of the embedded call. So please write down 3:2. 3 long bond, 2 short equity.
This is what in strategy.
In strategy only you can write.
Two, could you come again?
3 bond long.
3 bond long and 2.
Plus 2 short stock. Why is short stock? Why is stock 2, not short stock? Why is stock only 2?
Because delta is less than 1.
Correct. Exact. Absolutely right. Okay. Then what is the role in portfolio? They perform best during normal market conditions when liquidity is available. Please write down in role of portfolio, perform best during normal market.
Normal market.
When market is stable and liquidity is available and volatility is minimal. Perform best in normal market.
Okay.
And they do not perform well in periods of illiquidity or acute credit weakness. Okay, that you need not write down. If you write one line, it is sufficient. Perform well in normal market. Okay.
Yeah.
This is next strategy. We have finished what all?
We finished relative value, event driven, and equity.
Correct. Next, we have 3 more: opportunistic, specialist, and multi-manager. Okay. So when we solve the MCQs, no, you please look at the Excel sheet and solve. There is no need to, because you will not remember some 25 strategies. No, how will anyone remember 25 strategies? It is, I mean, especially in the first reading, right? So when solving the MCQs, you can go back to your Excel sheet and look at an answer, because you have to read this chapter once more. And when you're reading it once more, the Excel sheet will be of extremely helpful to you. Okay?
Yeah.
Okay. So friends, I hope you understood what are relative value strategies now. So in my complete full lectures, I of course explain about various other strategies that are deployed by hedge funds. Now, there are a lot of demo videos on our channel. There's a calculator usage demo video and quite a few other resources that we have on our social media as well as YouTube channel. And we give out a lot of updates, notification, exam dates, deadlines, scholarship details, and all of that. So do subscribe to our channel so that you can always stay updated. Okay, all the very best.